All right, today we're going to dig into something a little unexpected. A brand new giant in a really old industry. I'm talking about a coal company called Core Natural Resources, or CNR for short. Now, this company just popped into existence in early 2025, formed by merging two old school players, Arch Resources and CONSOL Energy. So let's figure out how this new behemoth was born, and more importantly, if there's any value left to be found buried in the ground.
So let's just get it out there. Could a coal company actually be a smart investment today? I know. It sounds kind of crazy, right? In a world that's all about decarbonization, why on earth would anyone even look at coal? Well, that's the exact counterintuitive puzzle we're going to try and solve right now. And this really gets to the heart of the paradox. On one side of the coin, you've got an industry that everyone agrees is in long-term decline. It's facing immense pressure from every direction. But on the other side, some of these companies are just absolute cash-generating machines. We're talking about staggering amounts of profit. And that creates this really fascinating tension for anyone trying to figure out where to put their money. So right at the center of this whole debate is Core Natural Resources. It's a major player, supplying both the metallurgical coal needed for making steel and the thermal coal that powers our grid. And what's really interesting is that it's built on the foundations of two very, very different but equally experienced mining companies. All right, so let's get into the value proposition. Why are some investors getting excited about this? The whole investment case really boils down to one simple, powerful idea. The market is pricing this company for failure, but its actual performance? Well, that's telling a completely different story of incredible strength. Okay, first things first, let's talk about the price tag. The valuation here is kind of wild. Based on its 2023 results, the company is trading at an enterprise value that's only about 3 times its earnings before interest, taxes, depreciation, and amortization. That's EBITDA. Now, to put that in perspective, the rest of the market often trades for, 15, maybe 20 times that number? So yeah, we are deep in rock bottom territory here. And it's not like it's cheap for no reason. It's cheap despite generating an insane amount of cash. We're talking about a free cash flow yield of around 20% based on 2023 numbers. So what does that even mean? It means that last year, the company generated enough pure cash to equal 1/5 of its entire value on the stock market. Think about that. It's like buying a rental property that pays you back 20% of its purchase price in 1 year. That is an absolutely incredible rate of return. So you might be asking, okay, they make a lot of cash, but what do they do with it? Well, they're not just sitting on it. In fact, if we look at one of the parent companies, CONSOL, they returned something like 73%, almost 3/4, of their free cash flow directly to shareholders last year. We're talking dividends, stock buybacks, the whole 9 yards. That's a huge sign that management is committed to rewarding the people who own the company. Okay, so this all hinges on a really important question. Can you actually trust the people running the show to keep this performance going? And when you look at their report card, well, it's pretty impressive. On operational execution, actually digging the coal out of the ground safely and efficiently, they get top marks. Same for financial management. They've been super disciplined about paying down debt and, as we just saw, aggressive about returning cash to shareholders. And maybe most importantly, they've shown they can adapt, pivoting their strategy when the market gets tough. That's a big deal in this industry. So, how did CNR get to be so disciplined? To really get it, you have to look at where it came from. It's basically a tale of two miners, one a reformed risk taker and the other a steady survivor. Two very different stories. So on one side, you've got Arch Resources. You can think of them as the reformed risk taker of the duo. They went all in on aggressive debt-fueled growth, bought a huge company right at the peak of the market, and it blew up in their face. They ended up in bankruptcy back in 2016. But, and this is the key part, they came out of it leaner, way smarter, and absolutely laser-focused on discipline and profitability. And then on the other side, you have CONSOL Energy. They're the complete opposite. They're the 160-year-old survivor. This company has never filed for bankruptcy. Their entire history is about conservative management, operational excellence, and a relentless, almost obsessive focus on one thing, being the absolute lowest-cost producer in the game. And this timeline really lays out their two different paths. Look at 2011. That's when Arch made that huge, poorly timed acquisition. Fast forward 5 years to 2016, and boom, they're in Chapter 11, shutting billions in debt. Now, look at what CONSOL was doing around the same time. In 2017, they were making a very deliberate move, spinning off their natural gas business to double down on what they're truly great at, mining coal cheaply. It's these totally different journeys that eventually brought them together, merging Arch's hard-won financial discipline with CONSOL's generations of steady, low-cost operations.
Okay, but let's be real. It's not all sunshine and rainbows. We have to do a reality check here because any serious look at a coal company means facing the huge headwinds head on.
And look, the risks here are absolutely significant. You've got the long-term secular decline, right? The demand for thermal coal here in the US is shrinking. Then there's the huge pressure from ESG and regulators, which makes it harder and harder to get financing or insurance. And on top of all that, you have the simple fact that coal prices can swing wildly. Your profits are at the mercy of the global market. These are not minor issues. They are the elephant in the room.
But this is where the company's strategy comes in. They've built some really powerful defenses against these storms. The biggest one, their main moat, is being a super low-cost producer. This means they can stay profitable even when prices are in the tank. They also have a debt-free, actually a net cash balance sheet. That gives them extreme financial resilience. Plus, they're focused on exporting to places where demand is still strong, and they have a mix of both thermal and metallurgical coal to help smooth out those revenue swings.
So, let's bring it all together for the investment verdict. When you put it all on the scale, the deep value and strong performance on one side, and the very, very real risks on the other, what do you have? Is this a genuine cash cow, or is it a classic value trap waiting to spring? And I think this is the single most important takeaway. The investment thesis here isn't a bet on coal making some huge comeback. It's not a growth story, no. The idea is that you're investing in a well-managed, gradual, but highly profitable decline. The goal is just to collect as much of that massive cash flow as you can on the way down. You know, the well-known investor Monish Pabrai put it perfectly when he was talking about CONSOL's business model. He said, they're always at the bottom of the cost curve, always profitable. And that really is the ultimate competitive advantage in an industry like this. It means you're the last one standing. You can still make money at prices that would absolutely crush everybody else. So in the end, it all comes down to this one big question. Is buying into a company like Core Natural Resources a fool's errand? Is it just a classic value trap in a dying industry? Or is it one of those rare, maybe even once-in-a-generational opportunities to buy a phenomenal cash-generating machine at a price that reflects nothing but pure maximum pessimism? That really is the billion-dollar question.